All right, welcome back, class, to our PowerPoint slides where we left off with exemptions on our discussion in Chapter 1. Uh, so here's what happened with the new tax law with regard to exemptions. There used to be a deduction that you could take for each exemption that you were entitled to as a taxpayer. That amount, according to the tax law, the new tax law, is zero for 2018 through 2025. So exemptions become a lot less important. However, the concept of exemption is still in the tax law, and it still is referred to because many of the tax credits that are available, and we'll see them later in Chapter 2, will depend on who is entitled to claim the exemption. So the definition is still important, but so we're still going to go over the various ways that you could be entitled to an exemption for a person. So first thing is you're exempt. You can have a dependency exemption. The most common is qualifying child. So if you're going to be a qualifying child, you have to meet the 6 tests with respect. Notice that there is no income test if you are a qualifying child. There is nothing about how much income that child makes. It is simply about support, and the qualifying child cannot provide half. It does not say that the parent or the family member provides over half. It says that they cannot provide over half. So it's a not test, if you will. All right. There, notice the age is the biggest one, and in the home for half a year. Okay. So that's qualifying child. That is the best scenario, or the most common scenario, if you will. Now, when you have, of course, when you have divorced or separated parents and they contribute more than half, it's the custodial parent. This is who they live with the most of the time, and that can be overridden if they sign away their right to claim the child. So it follows custody, except if there's a Form 8332. Okay, so the non-custodial parent puts that form on a tax return saying that I get it, the dependency exemption, not the custodial parent. And so here's how you would fill that out for the current year, future years. All right, so if they don't fit as a qualifying child, they may be a qualifying relative and still be entitled to a dependency exemption. All right, so this case, the taxpayer has to provide more than 50%. Remember, it was not the dependent did not provide 50 or more. So this is a positive test that you have to provide a certain amount of support for this individual. This has a gross income test, and says the exemption is zero, or the amount of the exemption, or if for zero, the amount for this gross income test for 2018 is 4150. All right, 4,150. Pass the joint return test, citizenship test, just like the others did. Here's who fits in the qualifying relatives. Pretty broad, but not everybody. It's somewhat limited. Okay. Qualifying non-relatives. So there's a, if they're not a relative, they're not a qualifying child, they may still be a dependent if they live with the entire taxpayer the entire year. So you have some leeway on how much time you spend with them if it's on the other qualifying child or relative, but not if it's a non-relative. So the person you pick up off the street and live in with you, they have to live with you the entire year to be a dependent. And then they have to fit past the others. The support test still there, has to make less than 4,150 for the gross income test and joint test. So it's basically the same as qualifying relative, except for has to live with the taxpayer the higher year to overcome the fact they're not related. If there's a tie break, okay, parents always win if it's between a parent and a non-parent. If both parents qualify and there's no custodial parent, meaning they both have equal joint custody, exemption goes to the parent with the highest AGI. Neither qualifies to claim the child. It goes to the non-parent taxpayer with the highest AGI. Multiple support agreements. This is when the person that we're looking at claiming as a dependent is, say, grandma, and she lives in a rest facility, and several grandchildren or multiple people pay for that. They all put in money towards her support. So if that group of people puts in more than 50%, and then there's one person that puts in more than 10, then the other 4 or 5 or 6 people can sign off that they will allow that one person to claim the exemption. And so basically you would rotate it. So if you had 6 people, each year one person would take the dependency, and then they'd rotate the next one, and they would do the form each year a little differently. Okay, so that's form 2120. It looks like this. Okay, it gives the year and the person that you're talking about claiming the exemption, and then the people that are giving up their right to the other person. Okay, so Reginald is saying that Helen can claim Joseph as an exemption. A little more on the filing statuses. Anything about joint return, when you file joint, that's the most common for married couples, but it does mean that both of you are jointly and severally liable for the tax on that. Meaning that if the IRS is going to, if you later divorce, the IRS is going to go after both of you. Okay, and spouse's death during the year does not affect it. You can still file jointly. Now, if you don't want that liability, or you have some problem with your spouse in the sense that you can't get together on how much income or any of those kind of things, then it might be filing for it separately. There are some few ways that you might actually save money by doing this, even if everything's going well. But most of the time, married filing separately has penalties associated with it, meaning that you're going to have a higher tax by using that. Qualifying widower, we talked about that. The year of spouse death, we file jointly, but with no matter what, the first year, but then in the 2 years after the year of the spouse's death, you can continue to file joint return if you do not remarry and you pay 50%, meaning you support someone living in your home as a dependent son or daughter. So they have to be a qualifying child still living at home. Okay, not just a dependent, not just a qualifying relative, but a qualifying child living at your home. Then you can be a qualifying widower. So it's a very narrow definition. Head of household, unmarried but supporting a family, has a dependent. Okay, they expand this to abandoned spouses. They had people where one of the spouse took off and the other spouse couldn't find them to divorce them, so they technically were still married, but they couldn't find them to sign the return or anything. So if they took off for half the year and you're supporting your kids at home, and you can't find a divorce, then you can file head of household. So that's kind of to protect those that have been abandoned. So to be head of household, if you're unmarried, you have to provide support for a qualifying child or a dependent relative. You have to pay over 50% of a dependent parent's household cost. So if that dependent relative is a parent, it has to be over 50%. Now, here's kind of an interesting note. The dependent parent does not have to live with the taxpayer. So you can be head of household even though you are supporting your mother in a rest facility somewhere else. But if you're giving over 50% of that cost, you can still be head of household. All right. Single is divorce or legally separate at the end of the year. So who has to file a tax return? Who makes enough money? So there's a kind of a minimum that if you don't make more than this, then you don't have to file. We're going to learn about earnings for self-employment, but that's very low. If you have a business and you make over $400 net income, you're going to have to file a tax return. But if your gross income doesn't exceed the basic standard deduction and your additional standard deduction for age, if you're a non-dependent, then you don't have to file. Okay? So here, their income, filing jointly, they don't file unless they make more than $24,000. He's 60, claims his 9-year-old dependent as a dependent. So it doesn't matter that she's 90. What matters is he is 60. So his is head of household because she's a dependent. He's more than half of it. And gets 18,000, but no additional for being 90. That's only for her. If you're a dependent and you're over the standard deduction, remember the 1,050 or the earned income plus 350, then you have to file. You can add to the standard deduction for age and blindness, not just age like it was for non-dependents. Okay, so here's an example. She's blind. She made 2,900. Okay, her unearned income is 1,050. Then she has 1,600 for additional standard deduction, so she has to file. She's over that threshold for filing. An example, he does not have to file. Eva does not have to file because her gross income did not exceed 4,250, which is 1,050 plus the 1,600 for age and the 1,600 for blindness. And then Danny doesn't have to file because he is not over 1,050, which is in this case the higher of the two. Kid living at home makes 3,500, so gross income is 4,100, exceeds the earned income plus 350, so Alicia has to file. Some responsibilities that you have as a taxpayer, and then some principles for tax planning to make sure that you reduce it. Planning to save taxes is not illegal. After the fact, avoidance of taxes is illegal. So making sure that you have records so that you can claim a deduction is fine. Even planning to take a deduction, even doing something just to take a deduction. But pretending you have a deduction where there is none, that is illegal. That's illegal tax evasion. Planning to avoid taxes is legal.